What if the biggest buyer of United States government debt is no longer China or Japan or foreign investors at all? What if the buyer is now America itself? That sounds impossible at first, but something extraordinary is happening behind the scenes that could reshape the future of the dollar, gold, silver, inflation, and every investment market on Earth. Around the world, foreign governments are quietly reducing their appetite for United States Treasury bonds. At the very same time, the Federal Reserve and domestic institutions are becoming increasingly important buyers. Many investors believe this is only a temporary shift. Others believe it marks the beginning of an entirely new financial era. If that is true, then the consequences for gold, silver, and your purchasing power could be much bigger than most people realize. So stay with me, because by the end of this video, you will understand why the world is changing its relationship with American debt and why precious metals may become one of the biggest stories of the coming years. For decades, the United States enjoyed a privilege that no other country could match. Because the dollar became the world's reserve currency, nations around the globe needed dollars to buy oil, settle trade, and build financial reserves. Those dollars eventually found their way back into United States Treasury bonds. Countries like China, Japan, Saudi Arabia, and many others became major lenders to America by purchasing Treasury securities. This system allowed the United States government to borrow enormous amounts of money while keeping borrowing costs relatively low. That arrangement helped finance government spending, economic stimulus, military operations, and countless infrastructure projects. Investors viewed Treasury bonds as one of the safest assets in the world because they were backed by the full faith and credit of the United States government. During periods of uncertainty, global money rushed into treasuries because safety always came first. But over the past several years, cracks have started to appear in that system. Geopolitical tensions have increased, trade relationships have changed. Countries have begun questioning whether they should hold such a large percentage of their reserves in United States assets. Some nations are diversifying into gold. Others are increasing holdings of different currencies. Some are simply reducing exposure to American debt, little by little. China provides one of the most watched examples. Years ago, China consistently expanded its treasury holdings as its export economy boomed. Today, that trend has changed dramatically. Chinese holdings have gradually declined as Beijing focuses more on domestic priorities, financial stability, and reserve diversification. While China remains a significant holder, it no longer plays the same aggressive buying role it once did. Japan continues to own massive amounts of treasuries, but even there, changing interest rate policies and domestic financial conditions have affected investment decisions. Rising yields inside Japan give investors more reasons to keep money at home rather than investing overseas. Meanwhile, many developing economies have started increasing gold reserves at record levels. Central banks from Asia, Eastern Europe, and the Middle East have purchased enormous quantities of physical gold during recent years. That trend has caught the attention of professional investors because central banks rarely make large strategic moves without long-term planning. This raises an important question. If foreign buyers are becoming less aggressive, then who is purchasing the enormous amount of new treasury debt needed to finance growing government deficits? The answer surprises many people. Domestic buyers have become increasingly important. American banks, pension funds, insurance companies, money market funds, and individual investors continue buying treasuries. At various points, the Federal Reserve has also played a major role through quantitative easing programs that expanded its balance sheet by purchasing government securities. This process often creates confusion because many people imagine the Federal Reserve literally printing money and handing it directly to the government. The actual mechanics are more complicated. The Treasury issues bonds into financial markets. Investors purchase those bonds. Under certain monetary policies, the Federal Reserve may later buy existing bonds from financial institutions, injecting liquidity into the financial system. Although technically separate, these actions can significantly increase the money supply and influence interest rates throughout the economy. Now think about what happens when government borrowing continues rising while foreign demand slows. Someone must absorb that additional supply. If domestic demand weakens, the government must offer higher interest rates to attract buyers. Higher rates increase borrowing costs not only for Washington, but also for businesses, consumers, and homeowners. Mortgage rates, corporate borrowing costs, and consumer lending all become affected. This creates an extremely delicate balancing act for policymakers. If interest rates remain too high, economic growth may slow. Businesses invest less. Consumers spend less. Housing activity cools. Financial markets become more volatile. If rates fall too quickly, inflation risks can increase again, especially if government spending remains elevated. This tension explains why every Federal Reserve meeting receives enormous attention from investors across the globe. Gold and silver respond closely to these changing expectations. Unlike bonds, precious metals do not generate interest income. When bond yields rise rapidly, some investors prefer income-producing assets over gold. But when confidence in government debt weakens or inflation concerns grow, gold often becomes more attractive as a long-term store of value. Silver behaves differently because it combines monetary demand with industrial demand. Modern industries require silver for solar panels, electric vehicles, medical technology, electronics, aerospace applications, and advanced manufacturing. Even if investor demand fluctuates, industrial consumption can continue supporting long-term fundamentals. That combination makes silver one of the most fascinating commodities in today's financial landscape. Many investors focus only on daily price movements. Professional investors often pay much closer attention to structural trends. One structural trend attracting enormous attention involves government debt levels. United States debt continues reaching new record highs. Servicing that debt becomes increasingly expensive whenever interest rates stay elevated. Every percentage point increase in average borrowing costs represents hundreds of billions of additional interest expenses over time. That means policymakers face difficult decisions about taxation, spending, borrowing, and monetary policy. Markets constantly evaluate whether those decisions remain sustainable. Confidence plays an enormous role. Financial systems function because investors trust governments to honor obligations. If confidence stays strong, borrowing remains relatively smooth. If confidence weakens, markets demand higher compensation for risk. That dynamic affects currencies, bonds, stocks, commodities, and precious metals simultaneously. Many analysts believe we are entering a period where trust becomes just as important as economic growth itself. That helps explain why central bank gold buying has accelerated so dramatically. Gold carries no counterparty risk. It cannot default. It cannot declare bankruptcy. It has preserved purchasing power across centuries of financial history. During periods of rising uncertainty, institutions often seek assets with those characteristics. Silver benefits from many of those same themes while also offering exposure to industrial expansion. Renewable energy investment continues expanding worldwide. Solar technology consumes significant amounts of silver. Artificial intelligence infrastructure requires advanced electronics. Electric grids continue modernizing. Electric vehicles require additional conductive materials. Each of these industries contributes to long-term silver demand even beyond traditional investment interest. This creates a unique investment story rarely seen in other commodities. As global economies transition toward advanced technology, silver demand may continue growing, regardless of short-term market volatility. That does not guarantee continuously rising prices. Markets always move through cycles. Corrections remain normal, volatility remains expected, but understanding the forces behind long-term demand helps investors avoid emotional decisions during temporary market swings. One reason experienced investors remain calm is because they understand the difference between price and value. Price changes every day. Value changes much more slowly. When markets become emotional, prices often disconnect from underlying fundamentals. That creates both risks and opportunities. History repeatedly demonstrates this pattern. Fear drives selling. Optimism drives buying. Eventually, fundamentals reassert themselves. The current debt discussion fits directly into that framework. Investors are asking whether expanding deficits, slowing foreign demand, and changing monetary policies represent temporary adjustments or permanent structural shifts. No one knows with certainty, but the questions themselves are becoming increasingly important. That alone explains why conversations about gold, silver, debt inflation, and monetary policy receive more attention than they did just a few years ago. As we continue this discussion, the picture becomes even more interesting because several powerful trends are now colliding at exactly the same time. As these debt dynamics continue unfolding, another major question emerges. What happens if the United States government eventually struggles to find enough buyers without offering much higher interest rates? This is where many market analysts begin discussing debt monetization. Debt monetization happens when central banks indirectly support government borrowing by purchasing government securities and increasing liquidity inside the financial system. Supporters argue this prevents financial crises and stabilizes markets during difficult periods. Critics argue that excessive monetary expansion eventually weakens purchasing power and increases long-term inflation risks. History provides examples of both outcomes depending on how governments manage fiscal and monetary policy. That is why investors should avoid simple conclusions. The relationship between debt inflation, interest rates, and precious metals is extremely complex. Still, there are several patterns worth watching. Whenever confidence in fiat currencies begins weakening, investors often increase allocations toward real assets. Real assets include gold, silver, energy, farmland, real estate, and productive natural resources. These assets cannot simply be created with a computer entry. Their supply grows much more slowly than paper money. That scarcity often becomes valuable during periods of monetary expansion. Gold has served this role throughout history. Silver has often followed while adding an important industrial growth story. Many investors underestimate how quickly sentiment can change. Markets spend long periods ignoring certain risks. Then suddenly, those same risks dominate every headline. Think back to previous financial crises. Before they happened, most people believed everything was stable. Once confidence changed, market behavior shifted very quickly. No one knows exactly when future turning points will occur. But understanding the underlying forces helps investors stay prepared instead of reacting emotionally. Another important factor involves the United States dollar itself. The dollar remains the strongest reserve currency in the world. No serious competitor currently offers the same combination of liquidity, transparency, and global acceptance. However, reserve currency dominance does not mean permanent immunity. Reserve currency status evolves over decades rather than months. Even small reductions in international demand can gradually reshape financial flows. Some countries now conduct more international trade using local currencies. Others settle energy purchases outside traditional dollar systems. These developments remain relatively small compared with overall dollar usage. But markets pay attention because trends often begin slowly before becoming more meaningful. Meanwhile, central banks continue adding physical gold to official reserves. That behavior sends a message. Even institutions managing national reserves believe diversification matters. Private investors naturally ask whether they should consider similar diversification strategies. Again, this does not mean abandoning traditional investments. Diversification simply reduces dependence upon any single outcome. Professional portfolio managers rarely rely upon one asset class. Instead, they build balanced exposure across different economic environments. Gold often performs well during uncertainty. Stocks often perform well during economic expansion. Bonds perform differently depending upon inflation and interest rates. Silver sometimes benefits from both monetary demand and industrial growth. Each asset plays a different role. Understanding those roles creates stronger long-term investment discipline. Another overlooked issue involves demographics. Governments around the world face aging populations, increasing healthcare expenses, and rising pension obligations. These commitments place additional pressure upon public finances. As spending obligations increase, governments often borrow more. Higher borrowing creates additional treasury issuance. Additional issuance requires additional buyers. The cycle continues. This explains why debt discussions are becoming increasingly important for investors who previously focused only on stock markets. Debt influences nearly every financial asset: mortgage rates, corporate borrowing, consumer credit, currency values, commodity prices. Everything connects. Now consider inflation. Although inflation has moderated from recent peaks, it remains one of the most closely watched economic indicators. Even moderate inflation gradually reduces purchasing power. Over 10 or 20 years, that effect becomes significant. Gold has historically attracted investors seeking protection against long-term currency erosion. Silver often follows, although with greater volatility. That higher volatility sometimes discourages new investors. Experienced precious metals, investors often expect volatility because silver historically experiences larger percentage swings than gold. Those swings occur in both directions. Sharp corrections frequently accompany powerful rallies. Patience, therefore, becomes extremely important. Many successful long-term investors focus less on predicting every short-term move and more on understanding broad macroeconomic trends. Debt expansion, central bank policy, currency confidence, industrial demand, geopolitical risk. These themes often matter much more than daily headlines. Speaking of geopolitics, recent years have demonstrated how quickly international relationships can change. Trade disputes, sanctions, military conflicts, supply chain disruptions, and energy security all influence financial markets. Whenever uncertainty rises, investors frequently reassess portfolio risk. Safe haven demand often increases. Gold usually receives the first wave of attention. Silver sometimes follows later once investment flows broaden. That pattern has appeared repeatedly throughout financial history. Another reason analysts watch silver closely involves mine supply. Developing new silver mines requires years of planning, financing, permitting, and construction. Production cannot increase overnight simply because prices rise. If industrial demand continues expanding while supply growth remains limited, long-term, market balances may tighten. This possibility attracts increasing attention from commodity analysts worldwide. Technology companies also influence future silver demand. Artificial intelligence data centers, renewable infrastructure, advanced semiconductors, telecommunications equipment, and electrification projects all require conductive materials. Silver remains one of the best electrical conductors available. That physical property cannot easily be replaced in many applications. Long-term industrial consumption, therefore, remains an important part of the silver story. Now combine that industrial demand with potential increases in investment demand during periods of financial uncertainty. You begin understanding why many analysts describe silver as one of the most interesting assets of the coming decade. Still, investors should remain realistic. Markets never move in straight lines. Corrections remain healthy. Temporary disappointments occur. News changes every day. The biggest mistakes usually happen when emotions replace discipline. That lesson applies equally to gold, silver, stocks, bonds, and every other investment. Successful investors constantly separate temporary noise from structural change. The current discussion about American debt belongs firmly within the structural category. Whether changes unfold quickly or gradually, the direction deserves careful attention. Because if foreign buyers continue reducing purchases while government borrowing remains elevated, policymakers may eventually face increasingly difficult choices. Those choices could influence inflation, interest rates, currency, strength, and precious metals for many years ahead. As investors continue watching these developments, one final question remains: what should ordinary investors actually do? The answer is not panic. It is not chasing headlines. It is not making emotional decisions after one dramatic news story. The most successful long-term investors usually follow a much simpler approach. They stay informed. They diversify. They think years ahead instead of days ahead. They understand that markets constantly experience periods of fear and optimism. Neither emotion lasts forever. When debt levels rise, investors should pay closer attention to fiscal policy. When inflation accelerates, they should watch purchasing power. When interest rates change, they should understand how borrowing costs affect businesses, consumers, and governments. And when central banks continue accumulating gold, they should ask why experienced institutions value physical reserves during uncertain times. The answer often comes back to confidence. Confidence supports every financial system. When confidence remains strong, markets function smoothly. When confidence weakens, investors begin searching for stability. Gold has filled that role for thousands of years. Silver often joins the story because it combines monetary history with modern industrial importance. That combination makes silver unique. It is both a precious metal and an essential industrial material. Few assets possess both characteristics simultaneously. This is one reason many analysts believe silver could experience larger percentage moves than gold during major bull markets. Of course, larger opportunities usually come with larger volatility. That reality should never surprise investors. Every major silver rally throughout history has included sharp pullbacks along the way. Patience has often separated successful investors from frustrated traders. Another lesson history teaches is that financial systems constantly evolve. the world moved from gold-backed currencies to fiat currencies. Interest rate regimes changed repeatedly. Trade relationships evolved. Reserve currency leadership shifted over generations. Technology transformed financial markets. Artificial intelligence now influences investment decisions. Digital payment systems continue expanding. None of these changes happened overnight. Most unfolded gradually until suddenly everyone realized the world had already changed. That may also describe today's debt environment. Many people still assume foreign governments will always finance expanding American deficits exactly as they have for decades. Yet the data increasingly shows a more complicated picture. Domestic buyers now play a much larger role. Central banks worldwide continue diversifying reserves. Gold purchases remain historically strong. Silver demand from industry continues expanding. Government debt continues growing. These trends are happening simultaneously. Whether they eventually produce inflation currency adjustments, higher yields, stronger precious metals, or an entirely different outcome remains uncertain. Markets always retain uncertainty. Anyone claiming absolute certainty about the future should be viewed carefully. Responsible investing means preparing for multiple possibilities instead of betting everything on one prediction. That is why portfolio diversification has survived every generation. No investor controls inflation. No investor controls Federal Reserve policy. No investor controls geopolitical events. But every investor controls risk management. Every investor controls discipline. Every investor controls emotional decision-making. Those choices often determine long-term success far more than predicting the next weekly market move. For gold investors, the coming years may present continued opportunities if monetary uncertainty remains elevated. For silver investors, industrial growth may add another powerful layer of support beyond traditional safe haven demand. For stock investors, understanding debt and interest rates remains essential because borrowing costs influence corporate profits. For everyone watching financial markets, this conversation matters because government debt affects nearly every corner of the global economy. As America continues financing record borrowing, while the world gradually reassesses its Treasury exposure, investors should expect continued volatility. Expect debates over inflation. Expect debates over Federal Reserve policy. Expect debates over deficits, taxation, and government spending. These discussions are unlikely to disappear anytime soon. Instead, they may become even more important throughout the coming decade. That is exactly why smart investors continue watching not only stock prices, but also Treasury auctions, central bank activity, inflation reports, employment data, and precious metal markets. Each piece tells part of a much larger story. A story about confidence, a story about money, a story about the future of the global financial system. Whether foreign buyers eventually return in larger numbers or domestic institutions continue carrying more of the burden, one fact remains undeniable. The era of ignoring government debt is over. Debt now sits at the center of nearly every major economic conversation. Gold and silver investors understand that reality perhaps better than anyone else because precious metals have always reflected confidence in paper currencies. The next few years may reveal whether today's concerns become tomorrow's defining financial trend. Until then, the smartest strategy may be staying informed, remaining patient, and focusing on long-term fundamentals instead of short-term noise. Because while headlines change every single day, the biggest economic transformations usually happen slowly until one day everyone realizes the world has already entered a new chapter. If you found this analysis valuable, make sure you hit the like button and subscribe to Silver and Gold Watch for more updates on gold-silver inflation, interest rates, and the biggest financial stories shaping our future. Share your thoughts in the comments below. Do you believe foreign demand for United States debt will recover, or do you think America will increasingly finance its own borrowing while gold and silver continue gaining importance? I would love to hear your opinion. Thank you for watching, and I will see you in the next video.